Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors. March 7th, right up against the close, 2 minutes before. Let's take a look at what's working and what's not working. I know if you look at TV, look at the news, we see daily what the headlines are doing to different sectors, but let's take a step back and try to see where we sit in terms of positioning and what can be the plan going forward. In terms of year to date, take a look at this chart. Healthcare, been dead for a decade, it feels like. Having a very solid year, up 8%. The opposite can be said about our former leaders. Technology, consumer discretionary, down close to 5 and 6%. It feels from an index standpoint like a much heavier drawdown because discretionary and technology make up such a large slug of the S&P 500. So if we, in and of itself, we're seeing decent action in the other sectors. So equal weight, which is not heavily influenced by any one sector or one industry, is having a decent year. The equal weighted S&P 500 outperforming the cap weighted 500. So now we run into a decision from a portfolio management standpoint. We're fairly balanced between growth and value. Where do we start to push in some of our chips here? And this next chart will give you a picture of the dilemma that we battle daily, weekly. We do lean on relative strength, on analytics. Take a look at this 1 and 6 month return chart. We just went over the year to date, so that's going to equate closer to the 30-day or the 1 month, which is in green. You can see discretionary, communications having some weakness on the 1 month. Where are we seeing some positive runs? In the defensive areas, staples, real estate, healthcare, as previously mentioned. But what happens when we zoom out? When we zoom out to 6 months, we see the stark opposite or diverse view of those same sectors, right? What has been hurt the last 30, 45 days has been the champ over 6 months. Communications, discretionary, monster moves. We know the banks, the insurance companies within the financials. Look at those strong moves. The strength of the last 30 days in complete opposite to the last 6 months. You see weakness in healthcare. You see weakness in materials, staples. So where do we position capital? Is the short term starting to overtake the long term? In other words, is this a shift that we must respect fully? Or is the trend in the intermediate and long term solid and we're seeing a natural pullback? We're playing this similar to how we did in August of 24. Seems like a long time ago. Investors, traders may not even recall that the S&P and the NASDAQ took it on the chin August into September. Rates were tricky. There was headlines with the elections coming up. Everyone wanted to climb into a hole. Everyone wanted to wait till after the election. Again, that's noise. We need to look through that noise on price action. So while we respect the short term, we're certainly keeping our long-term growth bets on. And you see that show up in how we added into the weakness of the last 30 days to cybersecurity ETFs and software ETFs. Did we nail the bottom? I doubt it. But we're trying to surround that pullback with the thought that the longer-term trend remains positive in those areas. So just some of the things we look at. What's encouraging? Last Friday and then this Friday, in the afternoon, there was a bid to the equity market. Why is that important? The Friday close to a trader and to an investor, but primarily to a trader, is the most important close of the week because you're taking 48 hours of risk. Now, we can talk about off-laying risk in the different futures markets off-laying risk overseas, off-laying risk in the crypto markets, that's a different story. For the traditional trader of equities and equity-linked products, that Friday close, when it's showing strength, is a little vote of confidence that a trader feels good taking 48 hours of risk versus the 10 or 12 hours of risk you'd normally take during the week. Just something I've always paid attention to. Moose couldn't be with us this week. I've got him out working hard. I got to keep Moose working hard. So he's out traveling. He's on the east coast of Florida. In terms of bonds, what did we see this week? Back and forth. We've been mentioning now for a while that range of, let's call it 4.25 on the 10-year, on the low side yield-wise, to 4.75 seems to be an area that has a churn to it. So we've traded down last week to 4.15 on the 10-year. We're about 4.30 now. If anything to tuck away and pay attention to next week in bonds, spreads have widened. Not a lot, a little bit. What are spreads? We look at spreads versus the Treasury. So if you can get a 4.30 on a 10-year Treasury, what are we looking at on a 10-year corporate or a 10-year taxable muni? And then so on and so forth, all the way down to 10-year junk, 10-year lower rated, double B, double B plus, triple B minus paper. They were trading very close to Treasuries. You could say a 10-year tightness versus Treasuries. You weren't being paid a heck of a lot to own lower rated bonds versus Treasuries. That spread has started to widen. That's normal. Lower rated credit and any corporate credit will trade a little closer to equity volatility than Treasuries. So we'll keep an eye on that spread. We don't want to see that spread blow out. If a spread blows out, if you're able to get large, high yielding coupons in A minus, triple B, double B plus paper versus Treasuries, it shows that the investors are concerned, they're worried about being paid back. So we'll keep an eye on those spreads. Just something John and Ben Pease keep an eye on a daily basis. Enjoy the weekend. We'll see what the markets have in store for us next week. I'm looking forward to it.